What's up everybody, Nate here, and the Federal Reserve just raised its benchmark interest rates by 75 basis points or 0.75%, their fourth consecutive 75 basis point hike this year, and now their benchmark rates sit at their highest level since 2008. So with all of that being said, today I want to go over what the Federal Reserve just did, what they just said, who all of this is going to affect, and what we can expect to see from our economy and the Federal Reserve in the future. And to start, I want to go over some direct quotes from the Federal Reserve themselves, and of course, Federal Reserve Chairman Jerome Powell. All right, so the Federal Reserve raising its interest rates by 75 basis points was pretty much predicted by a lot of Wall Street analysts and economic experts. This now puts the federal funds rate at around 3.75 to 4%. When talking about if the Federal Reserve is going to continue to raise its interest rates in the future or if it's going to start bringing them down, the Federal Reserve said, quote, "We will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial development." So let's kind of break that down. So the first statement, the cumulative tightening of monetary policy. So the Federal Reserve is taking a look at all of their interest rate policies thus far, and they're kind of looking at how all of that is affecting our economy. And it so far has affected our economy big time. Although the reason the Federal Reserve is able to raise its interest rates so aggressively is because of those lagging factors. All of their interest rate hikes up to this point haven't really had the desired effect that they want them to. Remember, the Federal Reserve is trying to erase and eliminate a lot of the demand in our economy by raising interest rates. This makes it a whole lot harder for individuals and businesses and investors and banks to borrow money. So that means a lot of these individuals and of course corporations are not going to be doing that, meaning there's going to be less economic activity. And when you have less economic activity, that means, well, you lose jobs and also you lower inflation because nobody's really able to spend as much money as they were before. It's a whole lot harder to get your hands on debt. But the Federal Reserve hasn't really seen that, even though they've been pounding these new interest rates for basically the entirety of 2022. So that's where they go into the lagging factors. Now, what we have to talk about next with the Federal Reserve raising its interest rates comes down to what exactly are these interest rates going to affect? And like I said before, the interest rates are aimed at kind of eliminating the demand for debt in our economy. Investors are not going to be able to take on debt or a loan to invest in businesses, and Americans are not going to be able to go out and get a mortgage as easily as they could over the last couple of years because interest rates are so high in 2022. Over the last 2 years, they were near 0%, so that meant that the housing market was going to explode, and it meant that all of these other business markets, like the stock market, were also going to go up, and we definitely saw that with all of these markets hitting a record high in terms of prices. So that is the first and foremost thing that's going to be directly affected by these interest rate hikes from the Federal Reserve. People are not going to be able to get a mortgage, so mortgage demand is going to continue to go down because interest rates are getting way too high. Recently, they crossed the 7% mark, so millions of Americans are going to be barred from getting a mortgage. So the housing market is going to be one of the first and foremost markets that is going to be affected by this interest rate hike. But the next, of course, is going to be your business enterprises, and it's going to be your stocks on the New York Stock Exchange. All of these businesses that are publicly traded and even some private startups and venture capital firms are also going to get hit really hard because now they can't borrow as much money, which means these businesses are not going to be able to expand as quickly. And all of these companies that don't really make a profit and aren't doing super well, they are going to get hit hard by these interest rate hikes. The only reason that they're able to survive so long, a lot of these companies rely on that investor liquidity, and without it, they're going to have to figure out ways to stay profitable or stay in business, and that usually means cutting something, whether it's a product, whether it's an entire supply chain, or it could be people. And of course, the cryptocurrency market is going to get hit hard too because now people don't have as much money to spend in that industry, and because crypto is pretty risky, they're now spending their own money. Investors are now putting their own money into a lot of investments, and well, if things don't pan out, now they're going to lose a ton of cash up front, and they're not going to have that money to invest in the future, which hurts their bottom line and the growth of our economy as a whole. But these are all lagging indicators. So the Federal Reserve raises its interest rates and nothing really changes immediately, but eventually you start to see a lot of these businesses run out of money. You start to see a lot of these companies lose that investor liquidity over time, and that's what the Federal Reserve is looking for as it raises its interest rates. It wants these businesses to start cutting people and cutting products and starting to pull back a lot of their spending. That way we don't don't have as much spending as a whole in our economy, but that's going to take time, something that the Federal Reserve Chairman Jerome Powell said during his speech. We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. However, he also added, quote, "So that time is coming, and it may come as soon as the next meeting or the one after that, but no decision has been made." So the Federal Reserve, as of right now, is going to continue raising its interest rates aggressively because a lot of the factors that they want to be affected by their policies, like the housing market and the jobs market, aren't really coming down as quickly as they want them to. Unemployment in the United States is at 3.5%, a 4 or 5 decade low, which means there's a lot of people employed, and all of those people are making way more money than they used to because of inflation, which means they can go out and buy more. Companies have a higher cost, and right now companies can't really take on higher costs because they're not able to get that investor liquidity. So they're relying solely on sales, but they're not really getting those either because costs are so high. So this is just kind of a really big problem that can spiral out of control if you don't have price stability. So the Federal Reserve has to continue to raise its interest rates until a lot of that consumer demand and investor demand comes down. But those are the things that can be affected by the Federal Reserve and its interest rate hikes. But there's a lot of other things that can't be affected. Like the Federal Reserve raising its interest rates is not going to directly bring down prices for energy or food or shelter directly, but it will have an indirect effect on them because people are going to ultimately lose their jobs and get cut because of these interest rate policies. And with fewer people employed, fewer people are going to spend money, which means fewer people can buy things and prices will come down because now there is a larger supply. And that, at the end of the day, is what the Federal Reserve is looking for: larger supply. They want to kind of fix our supply and demand problem by sucking demand out and giving supply time to hopefully catch up. But in that direct statement from the Federal Reserve, they did give a slight hint on when they would stop raising their interest rates, and right now that is believed to be around the 5% mark. Now that is a Wall Street expectation, not something the Federal Reserve has actually said. So right now interest rates are around 4%, so that means over the next year or so they're going to go up a whole lot more aggressively. But what that means is that from this point on, the Federal Reserve may actually start slowing down their interest rate hikes. Again, we do not know what the Federal Reserve is going to do next because everything that they do is going to depend on what inflation is and, of course, what the data is in our economy. But for right now, it looks like they might start to slow down in the next coming months. To be clear, though, they're not going to be stopping their interest rates or reversing them anytime soon. They did say that that time could be coming, but they gave no timeline for that. So we can expect interest rates to continue to go up and up and up, and that is going to cause some economic pain the higher those interest rates go. But this is the balancing act that the Federal Reserve has to do because the Fed wants to bring down inflation in our economy because consumer prices and the cost of living and everything else is hitting a record high. We saw the stock market hit a record high in 2021, the housing market hit a record high last year, the cryptocurrency market, and again, pretty much any market you can think of. But now the Federal Reserve needs to reset our entire economy and everything within it so that way prices can get back to a level that makes sense fundamentally. Everything was pushed up because of really low interest rates and a ton of money printing, but now with all of that coming out, everything is basically going to return back to where it was just before all of this started, and that means pre-pandemic. So that means prices in the housing market could eventually come way down back to where they were pre-pandemic. The stock market is already hovering around where it was pre-pandemic, and the cryptocurrency market, Bitcoin in particular, has lost most of its gains that it's gotten over the last couple of years. So the reset has began, and now the Federal Reserve is accelerating that by raising interest rates even more. So the Federal Reserve has to be really careful, and because inflation and everything else is so high, they now have to play the balancing act between lowering inflation and, of course, keeping us out of a recession in 2022. But the Federal Reserve cannot do both at the same time, and that is extremely important for you to understand. Right now, the Fed has a duty to bring down inflation in our economy down to 2%. Right now, it's at over 8.2%. So like Powell said, they have a very long way to go until inflation starts to come way down. But to get that done, the Federal Reserve is going to have to continue to raise its interest rates until there was just no demand in our economy at all, and then you do start to see prices going down and then stabilize. Once that happens, the Federal Reserve can then start to worry about our economy, but they play the balancing act because because with them raising their interest rates really quickly and aggressively, that could potentially send us into a really bad recession. Really just depends on what our economy looks at, and that's what the Federal Reserve is talking about when they say lagging indicators, and they're going to be looking at economic developments to determine how high their interest rates need to go. If our entire economy is in a terrible, horrible, bad recession, and the Federal Reserve may start to flip the script and actually lower their interest rates in 2023 or 2024. That would mean a whole lot of economic expansion once again, and it would probably bring us out of a recession, but it could also mean inflation goes back up. So that's not really a great thing if you start to see that. It's really just something that the Federal Reserve is going to have to keep an eye on. But if these lagging indicators come down slowly and the Federal Reserve kind of keeps an eye on inflation and the jobs market and of course the housing market, then they may not need to raise their interest rates that much higher into 2023 because inflation and everything else is starting to come down because we're gaining a whole lot more supply based on what the Fed and our entire business cycle and other economies around the world are doing. That means that supply is coming up naturally on its own and demand is also starting to come down just enough to where inflation is coming down too. So the Fed shouldn't have to really step in that much more at that point. So they don't want to raise their interest rates too quickly, even faster than they have before at this point, because they're starting to get the idea that inflation might be starting to come down and our economy might almost be completely through this entire reset. Overall though, what we can expect from our economy is for it to basically contract into 2023 because the Federal Reserve is making all of these economic conditions really restrictive on everything. And that is in an effort to bring down prices and everything else in our economy from their record highs. So I don't expect the Federal Reserve to lower its interest rates anytime soon, but I do expect them to kind of slow down everything that they're doing into 2023. So that means the reset in our economy is in full swing right now, and we can expect some pain ahead. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.